Futures pointing to a higher open, 36-point gain on the Dow futures after a modest gain on the blue chips yesterday. This is following President Trump's speech last night, but will division in Washington weigh on markets? Joining us now is Investmark Advisory Group Principal Michael Lee. Tight calendar for Congress when lawmakers come back from recess. I said that the sell-off last week was in large part because it looked like, the more it looks like the agenda is at risk, the harder the markets are going to take it. All the debate about how President Trump presented himself was less important to investors.
We've seen these sell-offs a couple times before with President Trump. Most recent that comes to mind is when he fired Jim Comey, and then the leaks came out to the New York Times. What I think a lot of people are missing is that the only way to get the Senate or Congress to act is to threaten them with job security. You have 10 Dem senators in Trump states. You have 20 Republican congressmen in districts that Hillary carried. So these people have to act or they're going to have to find a new job. So I think you're going to start seeing this come together. I wonder if this Afghanistan strategy is an olive branch to the establishment, if you will. But so far it seems like the swamp is beating President Trump.
We had this sell-off in recent weeks, but how much are investors going to be watching what's going on in Washington on Capitol Hill when they come back from break? Very often you see these swings, and you can disagree with me, you see these market swings on just one piece of news information in August. Not a lot of people are at work on Wall Street, and then also there's not a lot of other news out there as earnings season winds down. But how much is this market going to trade off D.C., not just in September and the debt ceiling fight, but even leading up to the end of the year?
Look, very, very important, right? But beneath and behind that, you just had an excellent earnings season. You had 73% of companies beat in the top line and 69% beat on the bottom line. You have improving fundamentals across the economy. Atlanta Fed is saying 3.8% GDP growth in the third quarter. That probably could come in some, but beneath the surface, beneath the headlines, you have a really good economic situation. And when you look out there and you have three assets, basically, you have cash paying zero, you have bonds, which I think are extremely overvalued, and then you have stocks. And well,
I know the 10-year yield closed yesterday at 2.18%, something like that, which is incredibly low.
There's a couple points that we're skipping around here. Is the Fed is a big market mover, and I think that's when you saw multiples on the market traded 15 times earnings to 18 times earnings to 21 times earnings. We have the Fed coming out later this week with Janet Yellen talking at Jackson Hole. We probably aren't expecting anything. I think as long as the Fed stays accommodative here and they don't make any sudden or rash moves, right, where we don't think there's going to be another rate hike later on in the year. They're actually going to pause on that. Their bond buying program, they're going to whittle it down even less than anticipated. Do you think that's the next catalyst for the market? Because right now people think it's overvalued. So where do we go from here?
So is that the next catalyst, or is the market already factors that in?
I take the complete other side of that. I don't think quantitative did anywhere near as much to move the markets. I think we've seen, while you've taken interest rates down, you've seen the hand of governments in the banks restricting lending. So if you look at the velocity of M2 money stock from the St. Louis Fed, it's grinded to a screeching halt. That's changing. Okay, as interest rates tick up and QE slows down and rates move out, I actually think that's going to be a positive and stimulative for the economy. If we do have a taper tantrum-like event, I think that'll be a screaming buying opportunity. I think that's what Jeff Gundlach was discussing in terms of volatility, and that we are going to see that's an event that's going to happen at some point in the next couple months, maybe 6 months. But I would say the Fed moving towards normalization is a positive, because these big banks that need to get money in the system can actually make a lot more money in the loans. If these loans are a lot more profitable, I think they're a lot more likely to take more risk and put stuff out there. And when I say more risk in the big banks, like, we're so far away from where we were in 2007, 2008. I don't think from the financial crisis anywhere on the horizon, but I actually think the Fed reducing their balance sheet, I think interest rates normalizing is a huge positive, because savers are going to start to make more money on their accounts, more likely to spend money. So I think the next 2 or 3 rate raises will be stimulative for the economy, not only from...
So you don't think they take a pause this year? By the way, QE is quantitative easing, which is bond buying, and Jeff Gundlach is a famous bond investor. Just or fixed income investor, just to
Yeah, well,
be clear.
We crowned the quote-unquote new bond king, but there's been some calls for volatility. So I think, look, if you look at where interest rates are and the future outlook of bonds, right? Interest rates are going to go up, bonds are going to sell off at some point. Cash pays you nothing, and stocks at 17.5 times earnings with 10+% earnings growth. That's really not super overvalued, especially when you take into account that these are the cleanest balance sheets we've ever seen in the S&P 500. So a lot less risk in stocks than I think people see. I think we can go much, much higher on the S&P 500.
And I've been preaching about the risk in the Treasury since, I think, 2009. So I've been wrong about that. Michael Lee, it's great to see you.
Awesome.
Thank you
Thanks,
for being here. Come back soon. Okay.